If you're thinking about flipping your first house this year to escape that 9 to 5, I need you to stop scrolling and listen to me very carefully. There's a statistic that the Lambo gurus on Instagram will never show you. In 2023, the failure rate for house flipping, defined as projects that sold for a loss or just barely even broke even, was approximately 22%, almost 1 in 4. Think about that. More than 1 in 4 investors work for 6 months, risk their life savings, stressed out over their families, only to end up with zero economic gain or even losing money paying to actually do the deal. And that's just the ones that lost money on paper. If you spend 6 months managing your contractor to make a net profit of $5,000, you didn't build a business. You effectively work for subminimum wage. This is called a functional failure. I'm Ryan G. Wright. I have been fix and flipping properties since 2000, and we teach thousands of fix and flip students. I've seen thousands of new investors come and go. The ones who fail don't fail because they're unlucky, and they don't fail because of market crashes. Today, I'm going to show you exactly what the mistake is, and I'm going to teach you the system, the same one we use at the Investor's Edge, to ensure you never make that mistake again. Let's get to work. The market split. The days when you could buy anything and make money just because prices were going up, those days are over. We used to say the difference between a good deal and a bad deal was just a few months. Well, those days are long gone. Back then, you could mess up and the booming market would save you. Today, with higher interest rates, tighter inventory, that margin for error simply is gone. But here's the problem. Most beginners, maybe even you, are suffering from what I like to call the guru effect. Gurus compress 6 months of renovations into a 22-minute narrative. They edit out the permitting delays, the contractor disputes, the materials that don't make it, the supply chain failures, and so much more. This creates a validity gap where you believe real estate is a design challenge rather than an arbitrage of distressed assets. If you treat this like a hobby, you'll never be able to make a profit in this industry. New capital enters, gets depleted by inefficient projects, and the exits permanently. I'm talking to the fathers out there, the mothers, the people who are looking to build intergenerational wealth. You can't afford to gamble on your family's liquidity on a hope. You need a system. At the Investor's Edge, we operate on 3-pillar-based system, the Find, Fund, Flip system. And today, we're focusing on the bridge between the find and the fund. We need to talk about the math that kills beginners. Let me introduce you to a guy named John. John's a smart guy. He has a good job, and he wants to flip a house. So John finds a house on the MLS listed for $210,000. He opens up Zillow. He sees a Z-estimate. The automated value says the house is worth somewhere over $310,000 after it's all fixed up. Here's the mistake. The Z-estimate fallacy. John trusted the logarithm. But Zillow itself acknowledges that its error rate for off-market homes, the primary target for flippers, is significantly higher than for on-market homes. The median error rate for off-market properties is 6.9 to 7%, and I've seen it even drastically higher. On a $400,000 project, a 7% error rate is a $28,000 variance. If John relies on that number, he might have just wiped out 70% of his profit before he even buys a single gallon of paint. The logarithm can't see inside the home. It can't smell mold. It can't see knob and tube wiring. So John buys the house for $205,000. He budgets $40,000 for repairs. He thinks sales price $300 minus the purchase price of $205 minus the rehab of $40,000 is a $55,000 profit. Looks great, right? Well, John's ignoring the soft cost. This is the invisible tax that drains the liquidity. John forgot that real estate is a time-sensitive asset. Holding costs, monthly interest, payments, insurance premiums, utilities, and accrued delays. You also have closing costs, transfer taxes, and agent commissions can amount to 6 to 9% of the transaction value on the seller side. Short-term capital gains. Uncle Sam wants his cut, which can reduce your yield by 20 to 35%. And then construction starts. John budgets for the best case scenario. But industry data shows that inexpensive renovators underestimate rehab costs by 30% on average, meaning they're 30% less than what they're really gonna cost. John finds a collapsed sewer line. That's well over $5,000. The project gets delayed 2 months. That's another $4,000 in interest. And suddenly, John isn't an investor. He's a victim of margin compression. He bought at 80% of the value, leaving no room for error. And a single plumbing issue wiped him out completely. Now, let's look at Sarah. Sarah is a student of the Find Fun Flip system. She doesn't trust Zillow, and she doesn't guess on math. She asks 5 specific questions before making an offer. Question 1, is the math real? Sarah uses the 70% rule. The formula is the maximum allowable offer, the ARV, times 70% minus repair costs. That 30% margin just isn't profit, it's a shock absorber. 10 to 12% goes to soft costs and closing costs, lenders' points. 6 to 9% go to selling costs, agent fees, and title. And the remaining 10 to 12% is the net profit. This buffer ensures that Sarah has an overrun, so she breaks even rather than losing capital if something goes wrong. Question number 2, is the source viable? MLS versus off-market properties. John bought on the MLS. Sarah knows that the MLS is a retail market. It's designed for maximum sale price for the seller. Sarah goes off-market. She uses the Investor's Edge finding software to find shadow inventory. She uses filters to find the perfect opportunity and operate with significant lower competition than the Shark Tank of the MLS. Because Sarah is solving a problem for a motivated seller, she buys the exact same house for $155,000. She created the equity in the moment she signed the contract. Question number 3, is the lender a partner or a predator? This is crucial. John went to a loan-to-own lender. They lend on high-risk deals with the secret hope that the borrower defaults so they can foreclose and acquire the asset. Sarah works with a lender who requires a structure for the deal and the probability of actual profit for the seller. At the Investor's Edge, we act as a validator. If we don't think you can make money, we won't lend. We validate the valuation and we scrutinize the budget. We even want you to come to us before you even start finding deals. Sometimes a lender like us telling you no is the most profitable answer you could ever hear. And number 4, we are financing 100%. John put $41,000 of his own cash into the deal for a down payment. That's capital he can't use for reserves. Sarah uses our 100% loan to cost model because she bought the deal right at 70% of the after repaired value. Our loan covers 100% of the purchase price and 100% of the repair costs. Sarah didn't need a down payment. She only brought the closing costs and insurance to the table, typically just 2 to 3% of the deal. This keeps her liquidity safe in her bank account, not trapped within the walls of the house. Question number 5. Did we budget for the fat tail? Sarah knows that 9 out of 10 projects have cost overruns. She builds it in. She builds a 15 to 20% contingency fund. When the sewer line collapses, she doesn't have to panic. She pays for it out of the budget she already planned for from the contingency. The results? John risks $41,000 in cash to make $5,000. Sarah made $50,000 with minimal cash out of pocket. Although these are just imaginary numbers, but they're accurate in real world scenarios. I share these numbers with you not to scare you, but to protect you. The horror stories happen when you let emotion drive your decision. And it happens with a lot of beginners. They fall in love with the potential of a house and they ignore the reality of the math. Strict underwriting is not a barrier to entry. It's a survival mechanism. If you're looking to leave your W-2, you need a partner who values your capital as much as you do. You need a system that helps you find the off-market deals. You need to fund them with up to 100% of our capital covering the purchase and the rehab, so we only have to come with closing costs, and flip them with guidance to avoid the pitfalls. We have a free training. It goes deeper into the find, fund, flip system. I break down exactly how to find these off-market sellers and how to qualify for a 100% funding program. Click the link in the description. Don't be like John. Do the math, protect your family, and let's build some real wealth. I'm Ryan G. Wright, and I will see you on the inside.